G7 Summit and US CPI data, major market moves coming next week. There are weeks in the financial world when multiple forces collide: geopolitics, economic data, and investor sentiment to shape the direction of markets for months ahead. Next week is exactly that kind of moment. As the G7 gathers for its 50th summit, marking 5 decades of influence over the global economic order, all eyes are also on one critical number out of the United States, the Consumer Price Index, or CPI. What makes this combination so powerful is not just the weight each event holds individually, but how their outcomes may align or contradict each other in shaping the future of monetary policy. Currency strength, commodity pricing, and overall risk appetite. The G7 summit, hosted in Italy, is expected to tackle some of the most pressing issues of our time: Russia's war in Ukraine, China's economic expansion, artificial intelligence regulation, and global energy security. These aren't just political topics, they directly impact financial markets. From defense and tech stocks to energy prices and the direction of gold and crypto. At the same time, the June US CPI data will test the Federal Reserve's inflation-fighting credibility. With markets currently split on whether the Fed will cut rates as early as September, this CPI print could tip the scale. A hotter-than-expected number would reinforce the Fed's cautious stance, possibly pushing rate cuts further out and strengthening the US dollar. A softer number could open the door to a pivot, igniting rallies in equities, bonds, and even high beta assets like Bitcoin. In today's episode of Money Minded, we break down exactly what's at stake. We'll guide you through the key agendas expected at the G7 summit, explain how markets typically respond to different CPI outcomes, and more importantly, we'll help you interpret these events through a financial lens. Because understanding the why behind the headlines is what separates reactive traders from strategic investors. Stay with us to the end as we reveal our forward-looking take on how next week's events could shape opportunities, or risks, in stocks, currencies, commodities, and digital assets. Chapter 1. G7's 50th Summit, Policies, Unity and Market Signals, 600 words. As the Group of 7 convenes for its 50th annual summit, symbolism meets substance. A half-century since its founding, the G7 stands at a crossroads, once a club of industrial powers shaping the post-war financial order, now a forum grappling with a rapidly fragmenting geopolitical landscape and the economic tremors that come with it. But while headlines often focus on the photo ops and diplomatic language, investors know that beneath the surface of these summits lie real policy clues that move markets. This year's summit, hosted by Italy in the Apulia region, places a strong emphasis on global security, economic resilience, and technological governance. Ukraine remains front and center, with discussion surrounding long-term funding mechanisms and defense commitments. While the war itself is not new to investors, what's evolving is the financial strategy. Proposals for leveraging frozen Russian assets to fund Ukraine's defense. If such mechanisms are agreed upon or hinted at, defense stocks and companies tied to NATO supply chains could react strongly. Watch names in the aerospace, cybersecurity, and logistics sectors. But Ukraine is only one part of a broader power struggle, and China is the other. Expect strong language on economic coercion and supply chain independence. The United States, Japan, and the EU have all voiced concerns about Chinese overcapacity and its impact on global trade. Semiconductor policy, EV components, and rare earth metals are all under scrutiny. Any coordinated statement or framework for countering Chinese economic influence could reshape investor expectations for global tech manufacturing and critical materials. This is particularly relevant for investors holding assets in Asia or in sectors vulnerable to retaliatory tariffs or trade restrictions. AI governance will also be on the table. The G7's Hiroshima AI process launched last year will see further development. While regulatory conversations are still in early phases, signals about harmonized frameworks or funding for ethical AI development could benefit select tech firms, especially those already aligned with Western standards on data protection and transparency. This is subtle, but valuable for long-term positioning in the tech space. Then there's energy security. With the energy crisis of 2022 still fresh in memory, the G7 will likely push for continued investment in LNG infrastructure, nuclear power, and renewable energy sources. For investors, this could be a cue to revisit clean energy ETFs, uranium producers, or infrastructure companies tied to cross-border pipelines and grids. But perhaps the most market-sensitive variable is unity, or the lack of it. The G7 operates on consensus. If the final communiqué reveals fractures, especially on topics like China, climate funding, or digital finance, markets may interpret it as weakness in collective response. On the other hand, a united G7 front, particularly with concrete policy commitments, can restore investor confidence in geopolitical coordination and multilateralism. It's also worth noting that while G7 countries are united in general values, their domestic pressures diverge. Germany is facing economic stagnation. France is dealing with social unrest. The UK is still navigating post-Brexit uncertainty. The US is heading into a divisive election. These tensions inevitably color negotiations and dilute the potential for radical or unified action. So what does this all mean for investors? In the short term, markets may react more to signals than substance. Any sharp language on China could boost the dollar and hurt emerging market assets. Defense, clean energy, and AI-related equities may benefit from policy clarity. In the longer term, if the summit produces credible frameworks, especially around economic resilience or AI standards, expect capital to shift gradually toward compliant sectors and regions seen as geopolitically safe. The G7 summit isn't just about diplomacy. It's a mirror reflecting how the most powerful democracies perceive global risks and how they plan to respond. For smart investors, reading between the lines of those reflections can be the key to staying one step ahead of the market. Chapter 2, US CPI data, a make-or-break moment? 600 words. While the world watches the G7 for long-term geopolitical alignment, markets are bracing for something far more immediate, the next reading of the United States Consumer Price Index, CPI. It's more than just a number. For traders, central banks, and investors across the globe, CPI is this month's most important signal. The stakes? Nothing less than the future path of US interest rates, and by extension, the pulse of global risk appetite. Let's set the scene. After more than 2 years of aggressive tightening, the Federal Reserve has entered a holding pattern, leaving rates at a 23-year high while signaling it needs greater confidence that inflation is cooling sustainably. But that confidence is proving elusive. Core inflation has remained sticky. Housing costs are still elevated, and wage growth, though moderating, hasn't completely decelerated. That's why this upcoming CPI release isn't just routine data. It's potentially the final piece in the Fed's decision-making puzzle before the Jackson Hole Symposium and the September FOMC. A hotter-than-expected CPI, especially if core CPI, which excludes food and energy, remains above 0.3% month-over-month, would almost certainly dash hopes for a near-term rate cut. Bond yields would spike, the dollar would strengthen, and equity markets, particularly tech and growth stocks, could face renewed pressure. That's because a delay in rate cuts implies tighter financial conditions for longer, which weighs on valuations, especially for risk-sensitive sectors. On the flip side, a softer CPI print, say, core inflation at or below 0.2%, would be a game-changer. It would not only validate recent trends in disinflation but also revive market expectations for a cut as early as September. In this scenario, we'd likely see bond yields drop, the US dollar weaken, and a broad rally across equities and crypto. Rate-sensitive assets like small-cap stocks, emerging markets, and even gold could benefit. But here's where things get nuanced. Markets don't just react to the headline number, they dissect the components. If inflation in shelter and services remains sticky, it could keep the Fed cautious even if other parts of CPI soften. Conversely, a broad-based moderation, especially in categories like rent, medical care, and transportation, would strengthen the disinflation narrative. Also, keep in mind the Fed's preferred inflation measure is the core PCE, not CPI. However, CPI often sets the tone for markets due to its earlier release and high visibility. That's why traders will hang on every decimal point, every whisper of pricing momentum. Beyond the numbers, we have to consider market positioning. Investor sentiment has shifted in recent weeks toward expecting a September or November cut, pricing in about 40 to 60 basis points of easing by year-end. If CPI data supports that view, it could trigger a powerful confirmation rally. If not, expect volatility, especially in sectors that have run ahead of fundamentals, like AI-driven tech and meme stocks. And don't overlook the international ripple effects. A strong CPI could push the dollar higher, tightening financial conditions globally and putting pressure on dollar-denominated debt in emerging markets. It may also lead to weakness in commodities like oil and gold, as real yields rise. On the contrary, a soft CPI could spark rallies in risk assets globally, provide breathing room for central banks in Europe and Asia, and even reprice inflation expectations across the bond curve. From a portfolio strategy perspective, this is a moment for agility. Whether you're a short-term trader or a long-term investor, understanding the Fed's reaction function and how markets interpret inflation data is key. This CPI isn't just a snapshot of prices, it's a mirror of central bank psychology. As we approach the release, remember, it's not about whether inflation is higher or lower, it's about whether it changes the narrative. And in a market built on expectations, that narrative is everything. Conclusion? As we wrap up this week's analysis, one truth stands out: global markets are entering a highly reactive phase, shaped not only by economic fundamentals but by geopolitical coordination and narrative management. On one side, the G7's 50th summit is more than a diplomatic tradition, it's a litmus test of Western unity in an era of economic fragmentation. From energy security to AI governance and China strategy, the outcomes of this meeting may not produce immediate legislative action, but they will shape investor expectations about the global policy environment for months to come. Clarity or division on key issues, such as sanctions, supply chains, or defense funding, will either restore confidence in multilateralism or highlight fault lines that markets must price in. On the other side, the US CPI data is the trigger event. Its role is binary yet profound, confirming or challenging the market's forecast for the Federal Reserve's next move. Whether it's rate cuts, extended pauses, or even renewed hawkish rhetoric, the implications of this inflation print will echo far beyond the US Treasury market. They'll be felt in the S&P 500. In currency pairs from US dollar to Japanese yen to euro to US dollar, in commodities, and especially in the increasingly macro-sensitive crypto space. What does this mean for you, the informed investor? It means this is not the week to sit back. This is the time to be proactive, not reactive. Markets are forward-looking machines. By the time a consensus forms, the opportunity may already be priced in. That's why dissecting the G7's tone and understanding the nuances in CPI components, not just the headline, gives you an edge. If you're overweight in high beta tech stocks, the CPI may be your green or red light. If you're trading currencies or commodities, the G7's position on energy and geopolitical stability might reshape your exposure. And if you're in crypto, where macro signals increasingly drive momentum, this week could deliver the volatility and opportunity you've been preparing for. At Money Minded, we believe financial news isn't just something to follow, it's something to read between the lines, interpret, and use strategically. Our goal is to give you not just headlines, but insight. Not just data, but direction. So here's our final call to action. If you found today's breakdown helpful, make sure to like this video, subscribe to our channel, and share it with others who want to be smarter about the global economy. We break down complex events into clear financial narratives, every week, on time. And always with an eye on what matters most to your money. Let us know in the comments. Are you expecting a dovish or hawkish CPI surprise? Do you believe the G7 will deliver meaningful unity? Or just symbolic gestures? And where are you positioning your portfolio ahead of next week? We'll be reading your thoughts and responding to the most insightful takes. Thanks for watching Money Minded. Stay sharp, stay strategic, and we'll see you in the next episode.